do I think Michael Oliver's prediction of $300 or $500 silver will come true? It's not a probable. If I was going to go for silver higher, the way to play it, I think, is just to keep stacking. Over the next 10 years, it might triple again and go to $180, but I don't see that happening this year. There's quite a few things which are in favor of gold, and all the ducks seem to be in a row. Would worry about in the short term is the direction of interest rates. First of all, we have a situation for government debt. If that were to happen, then of course it's game over. They have to restart the currency with the new currency. And then when I say restart the currency, it does not mean default. The currency you own, you'll find it much harder, if not impossible, to use it. There are armies of central banks and others who hold these government treasury bonds who at some point risk crying wolf or crying the emperor's got no clothes, and they say, I'm out of here, I'm going to switch into gold. The amount of gold held by central banks is now at record levels, and for the first time ever, it has passed the amount of treasuries. So I think we got to 25% gold and 22% treasuries.
I had Michael Oliver on the show around 3 weeks ago, and he said that based on technical indicators he's watching, silver could go to $300 to $500 this year. Of course, this brought on a lot of heckling in the comments, people saying this guy is crazy. It does seem unlikely if one looks at how it's performed since hitting all-time highs in January. Now, Michael's watching momentum-based analysis, a little bit different than regular technical analysis. Do you think that's a realistic proposition, that $300 to $500 target? And do you have a forecast for silver by the end of the year?
Many, many decades ago, long before we had computers to do this, I spent about 5 years using a huge amount of my spare time, almost all of my spare time, studying technical analysis. And I was trying to prove that technical analysis does work, because I had these books about technical analysis, they show various chart patterns. This chart pattern means this, and that chart pattern means that. So I bought from CompuServe or in America stacks and stacks of floppy disks with all kinds of data, which I then started with pen and paper, really, trying to figure out if this technical analysis would work. After 5 years, the conclusion, I gave up, because the conclusion I reached was it works about 1/3 of the time, 33% of the time. And 33% of the time, it seems to do the opposite of what the technical analysis says it should do. And the other 1/3 of the time, it does neither one nor the other. You end up where you started. So I'm always a bit skeptical about the people who draw charts and lines to try and prove where the future is.
Everyone is talking about Michael Oliver's explosive prediction that silver could soar to $300 or even $500. But veteran analyst Clive Thompson says investors need to separate possibility from probability. While he admits those price targets aren't impossible, he believes most investors are focusing on the wrong question. Instead of chasing spectacular forecasts, Thompson argues that the real opportunity lies in understanding what's happening to government debt, currencies, and central bank behavior. And according to him, what's coming next could be far bigger than a silver rally.
It's not to say that they're going to be wrong. They're going to be right some of the time. But I think you can't look at it in isolation. You have to look at it with other factors and then use the technical analysis to prove that or help reinforce your idea. So do I think Michael Oliver's prediction of $300 or $500 silver will come true? It's not a probable event. I haven't run a Monte Carlo simulation on the silver price, but I doubt very much that it would produce that kind of number. It might do at the sort of 5%, 95% percentile, meaning there's a 5% chance it could get there, but it's not going to give me that result as a 25 or 30% probability. So I wouldn't, if I was a trader, I wouldn't be buying long dated out of the money calls at that sort of level. If I was going to go for silver higher, the way to play it, I think, is just to keep stacking and not do it all in one day. Buy a little every week, every month, every 2 months, depending on what you can afford. And you'll get, along the way, you'll get an average price. Some of those prices will be higher than today. Some of those prices might be lower than today. You don't know which way it'll go, but at least you've got a nice average. And I think most of those, if you start now and keep going, probably most of your purchases will be below $100. And if it goes above $100 this year, you're going to be a very happy bunny.
Yeah, those are some great thoughts. I tend to agree. Although Michael has been dead on a few calls on the show before. He called silver going past $80. Everybody thought he was crazy when he talked about that. So who knows?
No, he's not crazy. I'm not saying he's crazy or anything like that. What he's describing as a price possibility is absolutely within range. It's just not a very high probability. One of the best tools I use for finding future prices is what's called the Monte Carlo simulation. The way that works is you take every price movement over a particular period, last 5 years, last 10 years, last 20 years, last 30 years, every up, every down, every percentage. You jumble it up, and then you throw it at the current price thousands and thousands of times to produce a potential range of chart prices. And it will produce you a sort of, starting at the current price, it will produce a sort of fat curve, and then it goes out into the distance. But it's going to cluster around what's been the long-term average over the period. So if we go back 10 years, for example, we've probably gone from, I haven't got the figure here, but let's say $20 to $60, for example. So over the next 10 years, it might triple again and go to $180, but I don't see that happening this year.
Very interesting thoughts. Now, I want to pivot to gold. Similar price action to silver, but of course less volatility in both directions. What are the main catalysts you currently see driving gold? And although we're down a decent amount since gold also hit all-time highs in January, do you still think the long-term trajectory is higher prices over the long run for the gold market?
I think it's almost inevitable that gold will continue to push higher over the coming years. And of course, it could happen very quickly. There's quite a few things which are in favor of gold, and all the ducks seem to be in a row. The one which perhaps we would worry about in the short term is the direction of interest rates, but that's a short-term problem. First of all, we have a situation for government debt where across the world, but I'm going to talk mainly the United States, we've reached a point which is somewhere between we can just about manage it and there's absolutely no hope for the government debt. We're going to go into a debt spiral where interest rates spiral out of control. Interest rates and yields spiral out of control as the price of debt goes down. Now, what happens there depends on confidence. So at the moment, we have a lot of confidence in favor of US treasuries and government bonds around the world. But as the level of debt continues to increase relative to the economy, relative to GDP, relative to the tax take, because it's the government debt is increasing faster than their increase in tax takes, is increasing faster than the economy is expanding. As that happens, the level of confidence amongst investors in that government debt becomes more precarious, and it can slip very easily from confidence, I trust the government, I'm going to get my money back, and I'm going to get money back which I can spend at a reasonable value, including the interest, compared with what I put in, to one of, you know what I get back won't be worth much. So that can slip very, very easily from one side to the other. Now, if that were to happen, then of course it's game over. They have to restart the currency with a new currency. And then that means, when I say restart the currency, it does not mean default.
Thompson explains that after spending years studying technical analysis, he reached a surprising conclusion. Chart patterns and technical indicators work only part of the time and shouldn't be used in isolation. That's why he's skeptical of silver reaching $300 or $500 in the near future. He says such a move is within the realm of possibility, but statistically it's a low probability event. Using Monte Carlo probability models, he believes extreme silver targets sit on the edge of the distribution curve rather than in the most likely outcome range. So what's his strategy? Simple, keep stacking. Rather than betting everything on a massive short-term spike, Thompson recommends buying consistently over time. Dollar cost averaging allows investors to build positions regardless of short-term volatility and avoid the risks of trying to perfectly time the market. While he's cautious on silver's near-term outlook, he's extremely bullish on gold over the long run. Why? Because the world is facing a debt problem unlike anything seen before. Governments continue borrowing faster than economies grow, and debt levels are increasing much faster than tax revenues. Thompson warns that eventually confidence in government debt could begin to erode. And that's where gold enters the picture. He believes central banks are already preparing for that possibility. In fact, central banks are accumulating gold at record levels while gradually reducing their relative exposure to government bonds and treasuries. According to Thompson, this isn't necessarily a rejection of the US dollar. Instead, it's a global diversification strategy. Nations want protection against sanctions, geopolitical risks, and an increasingly uncertain monetary system. He also warns that if debt levels continue expanding unchecked, future monetary reforms could become necessary. That doesn't mean an outright default, but it could mean new currencies, digital currencies, capital controls, or changes to how wealth is transferred and stored. Through all those scenarios, Thompson believes one asset remains constant: gold. If monetary systems change, your gold remains your gold. And that's exactly why central banks continue accumulating it.
It basically means the currency you own, you'll find it much harder, if not impossible, to use it because you're now forced to use something else, like the CBDC, like a stable coin, like a new dollar, whatever it happens to be. And it's not going to be easy to convert your old to the new unless you qualify in some way. And of course, if you're just the man in the street who's got his salary coming in, you've got a few $1,000s in the bank, it's going to be no problem. You'll see all your old converted to the new. But if you're a wealth accumulator and you have a lot of wealth in fiat assets, you're going to find it much harder to be able to convert those fiat assets into whatever the new currency will be, whether it be a CBDC or a stable coin or a new dollar or some sort of capital controls which control the manner in which you can spend your money. So that's why I think, from that perspective, gold is a very good investment because whatever's going to happen, it will get you to the other side. It's still going to be there. If you start with 20 gold coins, you'll still have 20 gold coins on the other side. And if it's a new currency, the price won't have any relationship to the old one. That, it can't make any, I can't say the price will be higher or lower because we don't know what the new currency is going to be worth or how much of it would exist and to what extent people are allowed to convert the old to the new. So that's the first thing. Now, I think central banks around the world can see what's coming. They don't say it's a certainty. And what I'm saying is this is not a certainty it's going to happen. It's just a scenario. Another scenario, and one which the government would very much like, is to continue what they're doing at the moment, which is continuing to borrow to repay the maturing debt, to continue to borrow to pay the interest, and to continue to borrow to finance the spending which exceeds the collection of taxes. That's what they'd like, and they hope that there's no major consequences. They hope that it doesn't feed through to the retail, the consumer price index. In other words, the consumers aren't saying, hey, that's not fair. The prices of what I'm buying, my pizzas and my sausages and my eggs are all going up faster than my salary is going up. That's not fair. That would be trouble if that happened. What they're hoping is that they can continue to print money. That money then goes through the system, greasing the wheels of the economy, finds its way into the hands of the wealth accumulators, business owners, who then take that money and invest it in the stock market or in gold or whatever else, and the price of everything goes up and everybody's a happy bunny because there's no losers. That's what they want. But there's no guarantee that's going to happen because out there are armies of central banks and others who hold these government treasury bonds who at some point risk crying wolf and saying, or crying the emperor's got no clothes, and they say, I'm out of here, I'm going to switch into gold. And now we are seeing that because we got this year, just announced by I think it was the IMF said it recently, or was it the European?
ECB.
ECB, yes, that the amount of gold held by central banks is now at record levels, and for the first time ever, it has passed the amount of treasuries. So I think we got to 25% gold and 22% treasuries is the figure I seem to remember. So central banks are clearly showing an inclination to have more gold and not as much treasuries in their portfolios. Now, it doesn't mean to say they're turning into wholesale sellers of treasuries. It doesn't mean to say they're trying to destroy the dollar. They're just diversifying, because especially the non-aligned countries, they're saying, well, what if we, for some reason, were sanctioned? What if Mr. Trump doesn't like the fact we're exporting too much to the United States and he tries to restrict our dollar dealings? So perhaps we should have other things as well. So countries are diversifying so they don't have all their eggs in one basket, and especially not a basket totally beholden to the United States. But it's broadly speaking the countries which are less aligned with the US point of view which are doing that. Then, of course, we've got, as I said, we've got this ongoing increase in debt, and we're also seeing an increase in money supply. Money supply is increasing by about 4.8%. Debt is increasing by about 7 to 8% a year. Those figures look like they're going to increase, and that's the real inflation rate. As the government borrows money, that's a promise to issue or print money down the line. So if they increase the debt by 8% a year, and that number has to go up, it can't unless they change something dramatic. So that 8% is going to turn into 9% next in a few years, and 10%. So that's the increase of the wealth on the planet, because all this debt is a promise to print the money down the line. And where does that money go? It doesn't go into buying more eggs or sausages or pizzas. It goes into tangible assets. Not immediately, it goes up and down with other things, but at the end of the day, it's going to go into tangible assets, whether that be land or collectibles or gold and silver or equities or anything else which people desire at that particular moment and which are in limited supply. So that money will go into those things, ultimately pushing up the price for as far out as the eye can see. But it's not like everything will be going up together. These things, you have your bad days for equities, and I think we probably will have bad days for equities, by the way. But when you have a bad day for one thing, it's generally good for something else. What you will discover is that if you had gold in the portfolio, any amount of gold, it would have improved your returns over any period. It would have improved your Sharpe ratio, which is the way portfolio managers measure the return you're getting for the risk you take. The higher Sharpe ratio is the better. Or it would have reduced your drawdowns. The amount of gold you should have had in a portfolio does vary by the starting date. There are dates when it would have made sense to have a 40% gold and 60% equities, and there are dates when it would have made sense to have just 10% gold, 30% bonds, and 60% equities. So depending on your starting date, you can choose the amount of gold. But the point is, gold in the portfolio at over any period of time worked. And if you had to choose a random date, the amount of gold to put in your portfolio is actually 30% mathematically. That was the optimal amount if you took all the dates as starting dates.
So while headlines focus on whether silver can hit $300 or $500, Clive Thompson believes investors should pay attention to the bigger picture. The real story isn't a single price target. It's the growing debt burden, rising money creation, central bank gold accumulation, and the long-term preservation of purchasing power. His message is clear. Don't build your strategy around unlikely forecasts. Build it around probabilities, diversification, and assets that can survive whatever comes next. If you enjoyed this analysis, make sure to like the video, subscribe to the channel, and let us know in the comments. Do you think silver reaches $100 first? Or does gold continue leading the precious metals bull market?